you got to ask your financial advisor where his advice is coming from. Is he selling you stuff he gets a commission on? Is he considering every asset class? And if he's not considering real estate, why not?
Welcome to the Path to Passive podcast, where we talk about building wealth and empowering lifestyle through commercial real estate investing for tech professionals. I always wish that other tech professionals reaching financial freedom had documented their journey along the way, so I'm doing it for the rest of us. Join us as we explore stories, many failures, and lessons learned along the way. I hope you enjoy and subscribe. In this episode, I get to spend some time with Stewart Heath, who founded Harvard Grace Corporation in 2010, which has since expanded into Harvard Grace Capital. Stewart has been a real estate investor for over 20 years, focusing on commercial real estate, including retail, self-storage, gymnastics facilities, and medical offices. Previously, he has held positions in COO and CFO for companies in retail, real estate, manufacturing, corporate services, entertainment, and digital media. He earned his CPA license in 1987 and has since held senior financial and operating positions. He also holds a BS in Business Administration from Auburn University and now runs Harvard Grace Capital, an idea that has been close to his heart for a long time, in an effort to provide stability for investors to engage in his community. One of the things I particularly like about this episode with Stewart is that we talk about his take on commercial real estate and why office buildings are not dead and why it's a great time for him and then his team to buy them. Also, the thing that is something that I hear a lot about too in industry is about picking separate markets and also just hyper focusing on one. And that's one of the things that we open up this episode on. So stay tuned and listen up for those talking points. Thank you and enjoy. Stewart, thank you so much for being here. I do appreciate it. We're in a group together, but by way of being on here, it's really cool. I'm really excited to get into some of the topics that you're a specialist in. And one of the things that really stood out to me when I was digging into some of the other content episodes that you were in was what you were talking about being hyper-focused in a market and not just asset class. And I know that's a question that comes up all the time. Should I invest in different markets? Should I invest in different assets? Right. And it's so easy, especially for, the listeners like myself on the show, my audience, tech professionals who are looking to diversify with, their high income and stocks that continue to invest and put in other places like real estate, which is why they're here listening to, many of the professionals and experts like yourself. And so, I'd love for you to, introduce yourself quickly and then, talk to me a little bit about your thesis, your strategy around, being hyper-focused in the market that you invest in.
Stephen, first, thank you for having me on. As just a quick introduction, I am a CPA. I've practiced for nearly 40 years. And several years ago, I started pivoting my fractional CFO practice to a real estate private equity firm. And I still have my foot in the other world as well, even though that's getting smaller. But I've had a lot of experience in a lot of different industries. Fell in love with real estate in about the year 2000, really from observing my own clients dig themselves out of holes or otherwise just build wealth slowly. Real estate. Nobody will ever accuse real estate of being a get-rich-quick scheme.
Right.
But it can very much be a get-rich-slow scheme.
Yeah.
Because real estate is, it's been around since God made dirt, and so it's the oldest industry out there. I know some people claim there's another oldest profession, but they had to do that in some piece of real estate. So so it moves slowly. It's not high tech. It's and it's just been around forever. So I'm very passionate about it. To me, the math is easy, and I'm a numbers geek, and it really all comes down to the numbers. So
I love that so much. That's so good. I haven't heard it that way before, but it's right on point. And anyway, I know you do It makes it even better because I had heard that you love to contribute and your hearts and, doing things for your community and your church, which,
Yeah.
I'd love to talk about too, but I just thought that connection was so funny. So,
Yeah. Well, it's a Friday. Let's have a little chuckle. So,
sounds good. Sounds good. Certainly, it's not the quote that always comes to mind is that it's not a get rich quick, but it's a get rich for sure. And so, provided you're getting educated, you're taking, you're doing your due diligence. I love that we have you here as an expert, someone that knows the numbers and seeing what other clients have been doing. And one of the reasons, that you got into it as well, like seeing, as part of your origin story. And, really interesting. I mean, you went from like one duplex to I think like 14, and then you had a portfolio of like 200, probably like units in like a condo or something.
Yeah.
And, held position as COO and CFO. I mean, you have experience across the board. So I'm really honored to have you here.
Well, thank you.
So, one of the things that I know you like to talk about, and I'm really curious to pick your brain on is, as we're going to get into is, interest rates, Wall Street versus, alternate investments, and of course, office buildings, which I know is sort of your bread and butter too. So, as we get into this, just talk to me quickly about how you think about being hyper focused, how you invest. Walk us through that.
Yeah. So, as opposed to a lot of the other people that you and I know and rub elbows with, we are not asset class focused. We are asset class opportunistic, and we're focused on a geography, and that's really just more of a practical position because we do the property management on everything that we bring to market, which means we got to be close.
Yeah.
And so we have to be within an hour of it to meet our parameters. And so we focus on an area that I call the 845-65 corridor, which is southern Middle Tennessee and northern Alabama. Northern Alabama is dominated by Huntsville, Alabama, and I'm a Nashville native, and it's pumping south really hard, and I'm kind of in the middle of both of these. And Huntsville, while maybe 30% the size of Nashville, it's pumping pretty hard north, and so these two things are pumping against and just creating all kinds of opportunities in these smaller, some people would call them tertiary markets. But frankly, since the pandemic and everybody stopped moving to the downtown areas, people are moving further and further and further out of the cities.
Yeah.
And technology enables that, right?
Exactly.
Because broadband is everywhere now. So, so there's lots of opportunities for multifamily, for storage, for office buildings, and things like that. That's why I'm not saying anybody else is doing it wrong. If your thing is to do multifamily and you just become absolute expert in that, more power to you. I mean, but if we're going to be doing the property management, we're just focused on our area. We're experts on the Tennessee Valley, and we tend to do simple deals in multifamily, which I believe is the core of all commercial real estate. I mean, you have to be familiar with the trends of the area and what's going on. I just don't want to manage it. So I can follow multifamily and do a storage deal. Those two correlate very well together. It just like storage and residential, single family homes, what I should say. And then office and everything else follows multifamily.
Yeah.
Retail will follow multifamily. Office will follow multifamily and retail, so forth and so on. So it's not a big mystery how all this stuff happens.
Yeah.
So we become experts in our market.
I think this is so cool. And I think, teeing up the problem statement for maybe people that are listening for the first time or maybe just to this episode, it's like you're sort of describing the wave that is of other assets that follow multifamily. Because at the end of the day, no matter what business you're in, it's a people business. Even
Yes.
if you're multifamilies and apartments, the money comes from somewhere. It
Yes.
comes from the people that are living and playing and breathing and working in that area. And so being geographic or market focused in that corridor you were talking about, lets you really kind of tune into what's going on. And I think that particular area you talked about many, maybe not the three-letter agencies, but military bases and those kind of infrastructure popping up too, right?
Yeah.
But really getting to know your market, one market versus what we might hear in other places, being in multiple markets and all doing multifamily in those. You're spread thin. You have to pay attention to so many more dynamics. But like your strategy, you get to know the market and you get to see just these different asset classes, the different chess pieces on that one board, right?
Yeah. It gives you opportunity to actually double down on some of the trends that you find. I can do a retail building and a storage, that
Right.
are all going to thrive off of this one multifamily boom. I mean, you just get a few different dips at the well, by knowing the market. So
Yeah, I'm really curious. You said you're from there, the area you've been there, and so how did you get to this realization? I'm actually really popped in my head. How did you get to this realization? Was it just you love it so much and the food is awesome and you never wanted to travel as much to these other places, and so you thought, why not invest
I
your
grew up south of Nashville, and so I've been in this area. I'm a little further south than that now, but I've been in this area, and so I'm an old guy now. And I used to kick myself in my 40s for missing Nashville's big boom. I mean, when I just came out of college, I could see what was happening, and didn't know how or what to do to try to take advantage of things. And then, 10 years later, I should have done this. I should have done this. And so when I started doing business and taking a look at Huntsville, I'm like, oh gosh, this is like Nashville 30 years ago.
Sure.
And I'm not going to miss it this time. So, and so that's how I got here. It's almost like my second chance, if
Awesome.
you would. So, and it's a great town, highly educated people. Their Chamber of Commerce claims to have the highest number of PhDs per capita than any other city in the nation. And well, yeah, they're all rocket scientists.
Yeah, literally.
And it's I don't know if it's true. It's probably true. They've been saying it for 10 years. So, you think that would go to some college town or something, but
Sure.
But there's a lot of colleges and then a lot of scientists there too.
Right.
So.
Got it. So you know the area, you see the opportunity. It just makes sense. So why not double, triple down into it right now? Yeah.
Right.
Perfect. Makes all the sense. And as you got more into it, the decision was pretty much organic. Why go other places if it's kind of right here in front of me, right?
Yeah, and the practicality to the practicalness of it is that, all right, our policy decision is we're going to manage it.
Yeah.
We have to be here. So, so we really can't, run over to Knoxville or Chattanooga or whatever. We could, but then you have to trust other people like property managers. So I'm not saying never.
Yeah.
I've just had really bad experiences with property managers, and most of them are really good people. But when you get to properties, just say sub $20 million properties, the model's broken. The property manager doesn't make enough money to keep good people on staff.
Got it.
I think property management is a great business when you got like 250 or 300 units of a multifamily or multiple buildings. There's just a practical economic reality that you've got to pay good people to get good results, and the properties that we invest in are just not that big. So.
Got it. And so the simplicity of it too.
really makes the sense. I
Yeah.
love it. I love it because it's such an advantage. It's such an, anyone that knows looking at business in general, it's the less, things you throw between teams, the less, more you have a tighter knit company, you're going to have, it's just more streamlined. So, no surprise being COO in the past, knowing what that looks like. So
Right.
I love that. Anyway, I just really want to drill in that because that's something that comes into people's head. Should I diversify in multiple markets, even as a passive investor, right? Or should I go into one and know that this operator is solid? They know it well, they know the game, etc. And so, yeah. So let's pivot here. Another topic that comes up is that you don't really care about how interest rates impact your investments, right? That might be a little bit polarizing to start, but how do they affect or not affect, or why is this a topic for you?
Well, everybody, we're all impacted by the financial media. Even right over here to my left shoulder, CNBC is running on a TV on the wall because I keep it on all the time. But they're there to make news, not really to inform us. And when you really get down to it, real estate deals are generally pretty easy, mathematically from the start. And rule number one is you make your money on the buy, not the sell. And so I am agnostic or just outright don't care what interest rates are at the moment because I can't pay, won't pay, more for the price than what I'm going to be able to generate at a minimum of 1.2 times debt service coverage and be able to throw off at least a 5% return on the equity of the deal that we're putting in. And so your bottom line. So you're just backing into the price that you're willing to pay for. And these go for stabilized properties, which make them sort of somewhat simple. I call them boring properties, boring deals.
I love it.
Because, we don't take development risk. We're not doing construction or anything like that. The properties are usually full. So you're just backing into the price that you're going to pay. And you're going to base that on current interest rates. It's not really a variable. Mm-hmm. It might be a variable within 75 basis points or something like that, because different banks will, incentivize you at different times. But 1 point at the most.
Right.
7.75 to 8.25 is kind of the band that we're in right now.
Yeah, it's marginal, right?
Yeah, and so yes, if you stay right in the middle of that. So interest rates really aren't a variable, and then you just back into what you can afford to pay, and therefore then you know what your cap rate is, and because the math is pretty finite. And then the only difference, then the only challenge is, will the seller sell for that number?
Right.
And there's a lot more of those sellers this year than there was last year. We all did a bunch of volume in 2022. Mm-hmm. 2023 comes around, of course, interest rates. We're raising during 2022 and kept raising first half of 23, and and the whole industry was down almost 60% from volume from 22 to 23.
Right.
And that's because sellers were not willing to sell. They still wanted 2022 cap rates when interest rates had gone up 5.5 points. And sellers, buyers are like, no thanks. We found a couple of desperate people and got a couple of deals closed last year. But they were in 8+ cap rate ranges. Now the good part about that is, deals that we're doing now at 8.5, 8.25, when interest rates do come down, they're going to be golden. If they work at 8.25,
that's right.
You're just, popping the champagne cork at 6.5 or 7. So, but that's why it really doesn't matter, because we're not gonna, we're all bound by the financial markets, unless you're a cash buyer.
Right.
Every now and then we come up against some competitor, some family office that has to place $100 million,
right.
and we don't care. Here's the price.
Okay.
And not the best decisions on their part, I think, but when you're investing with a 100-year time frame, you think a little differently. So.
No kidding, right? Uh, yeah, yeah. Anyway, so so what I'm hearing you say on this is that because the numbers are simple, right? And you're going to have to do your math to figure out, this is in context of buying, but math will be simple no matter what it is. But this is in context of
Right.
buying. It's that the interest rates don't really matter that much because people are still going to have to transact. We're still going to have to transact. And that means as long as the numbers come out where the purchase price makes sense because of what my returns will be, and I'm forecasting what it might look like if it goes higher up, a couple, amount of bips, like 0.5% or whatever, or it comes lower or goes higher, then I can account for that. But if it comes down by anything, then it's still money.
Oh yeah, yeah,
So
yeah. Our goal is to make a deal that's going to cash flow from day one,
yeah,
and so that pretty much dictates the purchase price on any property based upon their NOI. That's all based upon the NOI they have booked right then, and which is always the challenge. And that's the thing about commercial property. And like rule number one, you make the money on the buy, and that's true whether you're buying and holding or if you're fix and flipping.
Yep.
You can't overpay for the market, even if you think, lesson I learned a long time ago, and it was a hard lesson. You cannot push the market. I used to do fix and flips, and I put way too much money on them because I get excited as well. I want this to be something that I would be willing to live in. All right, well, came close to having to live in it a couple of times, and so you gotta check that. You can't overspend for the market. So,
Right. Yeah.
and you always make your money on the buy.
I love it. I know we can discuss that one at length, and if we have time, I really do want to circle back on that. But I do have a question because we're going to get into the meat and potatoes around office buildings here shortly.
Okay.
But you did mention something about a stabilized office building. Now, when I think stabilized multifamily, and I don't know much about office buildings, so you're my perfect expert on here, Stewart. Appreciate it. And so, but so multifamily stabilized is 90% or more. Right. And so what does stabilized mean for office?
Probably 85% or better. All of ours are 100%. And offices tend to, over time, they tend to be full. Or if there's a problem with them, they'll have much greater problems than that, because your average office tenant is going to be somewhere between 10 to 25% of your total space. So it's very different management-wise, management philosophy than a multifamily where a tenant might be one of 200 or one of 300 or it's one unit. So
Right.
The other side to that is your average office lease is probably going to be 5 or 6 years long. So you do all this work on the front end, you get them in. And you check in with them, once a quarter, make sure everything's going okay, and you keep the property clean and leave them alone because they're not there to be your best friend or anything like that. You just treat them well as you do in any business. So it's a really different dynamic. The longer term leases and when you go towards the medical end, the leases get even longer, 10 or 15 years. And then they're putting all kinds of dollars into that space for their own use. And so, and all of that means they're not likely to move, and most of these folks, if you if you maintain the property where it's a nice place for them to have an office, they're not likely to move.
Right.
And they don't want to move. Moving's a pain in the butt for everybody, especially businesses. So that's the game. It's about tenant retention after that.
Got it. So really some key topics to talk about there. The first one I just wanted to clarify on is you're absolutely right. In a multifamily property, let's say you have 100 units, each single person or family occupies one unit. So,
Right.
1/100th of that. And so the percentage breaks out pretty simple. But if we're talking about, commercial office space, you said one tenant might be like 10% or so. So you might have, depending on how big it is, I know there's a lot of, it depends, based on the t-shirt size of small, medium, however
Right.
big the space is. But, in general, there are chunks of capacity, right? But around 85% is stabilized. Is that right? Just a baseline on that?
Yes, generally.
Okay,
Yeah.
cool. And so when we talk about the types of office buildings that you and Harvard Grace like to acquire, what types of office buildings are you looking at?
Yeah. So let me go back and pick on the financial media again. Now that they've declared that office is dead again. If you remember 3 years ago, they declared retail dead too.
Right.
Nothing's ever that simple. Office has at least 6 subcategories.
Mm-hmm.
There's Class A, there's downtown business district. There's
Right.
medical office, which is an asset class. It's a massive subclass of office. There's
Yeah.
what I call suburban office. Some people call that service retail. I just love that stuff. And hardly any of that is under distress. There's only one subclass that's under distress right now, and that's the downtown Class A stuff. So to us, where it breaks down is, does the tenant base meet their customers there?
Right.
So we like stuff with dentists, with insurance, State Farm agents, Allstate agents, mortgage companies, and a lot of those are legally required to have office space, like a mortgage company or an insurance agent. They're generally, most state regulations don't allow them to work out of their homes.
Right.
And so, we love government regulation requiring them to have office. Your doctor and your dentist is not going remote. He ain't
Right.
coming to see you.
Yeah.
And so they have to have that kind of stuff there. And then there's just any number or a slew of different organizations, not-for-profits. I got multiple properties that have home health companies in them because
Right.
they tend to put regional offices around the big cities, all around, and they have to have a place usually once a week where they pull in all of their technicians to do training, once a week, and so they have to have that place there.
Yeah.
Usually, the rest of the week it's kind of empty, but they have to have that spot. And there's just any number of organizations that don't need to be downtown either. They just want to be close to home, and so you get these suburban offices, and which really nobody is talking about being under stress at all. The media just talks about office, 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 and I think that they're thinking about a bunch of stuff in downtown Chicago or New York, San Francisco, there's real pain happening, and I think it's going to get worse before that gets resolved. But out in the suburbs of even those cities, I think it's probably okay. So,
Yeah.
And that's why we love it. They can be cash cows. So.
Man, that's like, so, you're answering some of the earlier questions too of why stay in the market that you are in hyper-focus. Because office buildings like those ones that aren't Class A are prevalent, and they're the ones that are not, they're not that Class A. And so you have all of these others that are just, really, when you look at it like a business in a market, it's like, well, you want sure, great product, great service, all that stuff, but even better if you have a moat. And so that moat is government policy.
Yes, we like those too.
And so that really helps as part of the business plan for sure. So,
as an example for that, if I may, so we love the Huntsville market. Bunch of defense contractors down there, and so one of the exceptions to the Class A office issue is, you know, almost all of those defense contractors are required to have what's called a skiff. I can't ever remember what that means, but it's it's a top secret electronic signal blocking place to go in and do their work.
Yeah.
And so they can't go remote.
Yep.
And these buildings are generally Class A type stuff. And so we have and are pursuing some deals like on the Research Park thing. So that would break our rule of saying we don't do Class A. But yeah, we might do that one because it's that mandate thing. Well, they got to be there. Those employees have to come in. So the tenant has to have the space.
Yeah.
So, so office is going to go through some upheaval. I think the hybrid work model is here to stay.
Yeah, for sure.
But it's still hybrid.
Right.
When you own a hybrid, you're still buying gas. Know, so for the hybrid, they still have to have the office for the employee to go to. They're just letting them work at home some too. So I don't know what's all going to shake out. I'm just glad I'm not in some of those assets. So.
Yeah, sensitive compartmentalized information facility, SCIF, for the military and other. Yeah. So super interesting. Yeah, it's too much of a blanket statement, like you said, about office buildings being dead. It's just once again, it's one of those that where's the niche, even in the asset class itself, right?
Yeah.
So you guys look at whichever of those, pretty much anything that's not Class A, office.
Exactly. Yeah.
And just how in being hyper focused in the area you're in, how do you serve those tenants that serve their customers, that they have to meet with their customers on site or conduct their business there?
Yes.
The longer the lease, the better. Is that pretty much the mantra?
Always. In the suburban office, you're going to see a lot of 3-year leases, 5-year leases, unless it's the medical dental guys. They'll go 10 years. But what happened in 2020, when people, we had some renewals in 2020 and some properties, and we don't know what's going to happen, so I want to do a 1-year extension, and we were just happy to kind of keep them because we didn't know what was going to go on either.
Sure.
And so, they've been good tenants, and nobody knew if the world was actually ending, and especially in the first half of 2020. But what really happened was because the shorter the lease, the higher the rate per foot.
Higher the rates, right?
And so, what's happened since then is the whole industry has taken a step up to the next level, and now we're at this next level. Now they're going back to doing 5- and 7-year leases at the new level.
God,
I love this, and because there was a good 2-year hiatus of developing new retail and new office and whatnot,
right?
There's the landlords it'll be a short period of time. We've got the advantage at the moment.
Yeah,
in a lot of the markets that we follow.
So I just want to baseline for the listener who may not be familiar with all the different asset classes, not just the subclasses of commercial. So, we talked about multifamily apartments, but you gave a breakdown of some of the different niches, variety of asset classes in office. But then there's also things like, self-storage, mobile home parks, RV parks, et cetera. So when you're talking about office, you're basically talking about things that are like where the big box stores are, where businesses that have, in downtown have people, or in the suburbs, strip malls, retail centers, stuff like that, right? You're not talking about, or are you, self-storage? Is that part of this?
We do some self-storage assets as well, yes.
Okay. So some of the different subclasses of office and self-storage, is that about the two? It's basically what serves the rest of the community that follows where the people are, like you're saying, multifamily being the core. So the things that support the other. Okay.
Exactly.
Awesome.
Yeah. One of the first things you look at is what are the number of households in a radius around the property that you're looking at? Because, people, foot traffic, cars drives everything.
100%. Yeah. Yeah, I think depends area to area, but I remember it's like for every one, sort of professional office white collar job, it can support like up to 2.7 workforce jobs or so. It's pretty interesting. Obviously varies, but all right. So talk to me about this. I think this is kind of a great segue because real estate, gets looked at as an alternate investing class, which is wild because, everyone knows and heard growing up the back of their head, even if they don't know much about real estate, that, where did wealth get born and grow? It's in businesses and real estate. I mean, real estate is old as dirt. Maybe the second profession, Stewart. I got my eye on you. So, what do you think about this? Why real estate really shouldn't be an alternate investment? But it's mentioned that.
It gets my dander up, makes my hair stand on end. You can't tell, but Wall Street's been very clever.
Yeah.
Because they've made a lot of money, and in public markets and things that can be traded. Wall Street would also put most private securities, as quote alternative investments. And even now, 20, 25 years after the quote tech boom, still more millionaires have been made in real estate than in any other asset class since the beginning of time. And I'm not against tech. I'm not against, food companies. I'm not against public stocks. It's just, my position is, from a completely independent, unpaid financial advisor, you ought to have, 40 to 50% of your investment portfolio in cash flowing investments.
Yeah.
I recently did a blog post. I don't know that it's out yet, but Visual Capitalist. If you get that daily email, but it's a great site. They did a breakdown of the portfolio of Berkshire Hathaway.
Wow.
Who's the greatest investor of the world? Warren Buffett. And I don't disagree with that. But I looked at the portfolio, and then, being a geek, I put it in a spreadsheet, and then I started looking up all the stock symbols, and about 60% of what they do is dividend paying stocks.
Right.
And I think I calculated, gee whiz, they're probably getting about $4 billion a year of income just in dividends, whatnot. Their largest single position was Apple, which does not pay a dividend, but but it's that cash flow.
Yeah.
It's the boring stuff that allows you to go do the fun stuff.
100%.
I mean, it allows you to go do a venture deal or a development deal, and it's because, I lost it all. Good thing that half my deal is still, cash flowing.
Yeah.
I mean, the stabilized stuff, which you hardly ever hear about on financial media.
Yeah.
Not even, especially not the real estate, but they don't even talk about the dividend paying stocks much, because it's boring, and it's stable. And you just got to take all that into account. You got to ask your financial advisor where his advice is coming from. Is he selling you stuff he gets a commission on? Is he considering every asset class?
Right.
And if he's not considering real estate, why not?
Absolutely.
And a lot of them can't, and I get that, but everybody should just know. And there is a vehicle for everybody at any level to get in on real estate. So.
Yeah. I'm going to pull the thread on that one in a second, but thank God, that it's not stuff that you hear about all the time, because if it's making the news, then shit's upside down, right?
Yeah, it is.
So,
it is.
or
it's about to be bid too high, where it doesn't make any sense anymore. So
right, exactly. Right, exactly. And so, the boring business is the thing that are reliable. Like, great. There's not much fluctuation. It's the steady thing that keeps on trucking. It's there. It's paying you dividends. And I love that, that equation, the analogy, the mapping to even the Warren Buffett, visual capitalist stuff. They have such great images too. I mean,
They
really.
do. Yeah, I think my blog post is going to be titled "Warren Buffett Agrees with Me."
I love it. Well done. I'll put your name in there. The SEO will get you.
Absolutely.
So talk to me about that part. There's an asset class for everyone. Let me tee this up for you a little bit here. So the listener base, tech professionals, they're all accredited, for sure accredited.
Yeah.
We're somewhere between, let's say, 30 to 35-ish, right, in tech. Pick one of the FANG, MANG companies, whatever you want to call it today.
Right.
And so and most of them high pressure job, but they enjoy what they do. I mean, I know I have to keep up with tech and I have to keep up with technology and the industry and whatever, but I do really enjoy a lot of what I do. Would I like more cash flow? Of course. But you said there's an asset class or there's some kind of real estate for everyone. Where would you tell those people to start? What questions would you ask them?
Well, if they're all accredited, then they need to be looking at the plethora of private deals that are out there, through Regulation D, private placement offerings. If they're accredited, that's where the best returns are. What I was thinking about, on the other end, if you've got $500 or $100 a month that you can put into your Robinhood, well, find a good REIT.
Right.
I'm not a big REIT fan, but they have a place. There's a whole lot of the advantages you don't get with REITs, but it's still in real estate, and or you could opt to do some of the other dividend stocks. But for the accredited people, obviously I would love to talk with them as well, but I actually recommend that people, even though they may be passive, that they need to get comfortable with the market. And the easiest way to do things is just like when they tell you, don't buy a stock that's in a business you don't understand.
Absolutely.
It's why I've never bought crypto. I am not that smart. I don't get it, whatever. It's clever, but done by a bunch of really smart people. But I don't understand it, so therefore I don't invest in it. And that's what I advise everybody to do.
Solid.
Most of us can understand apartment buildings. Most of us have lived in one at least one point in our life.
Right.
And we get it, and people pay money to be there, and you can see how the aggregation of all of those family units, paying, you can understand how, wow, that makes a lot of money.
Right.
And there's not a whole lot to understand. And you should understand the market. And when I say the market, I'm talking about down to the street level, because rule number 2 is all real estate is local.
Boom.
Everybody's heard this. I don't know who originally said it, but it is so true. There is nothing more true than that property, has everything to do with what's going on around it. Mm-hmm. If you might have a brand new apartment building, but it's too close to a growing crime area, run.
Yeah. Simple.
Because that property probably has no future unless the local government's going to get after it and push back the crime wave. So,
yeah.
And those are the kind of things. Yes, you should expect your sponsor to think of those things and report those to you, but those are the things every investor, passive or otherwise. Just because you're passive doesn't mean you don't have the responsibility to check into it on the front end.
100%. So I really want to move forward on that, but I want to sort of summarize a part of that. So if I'm a tech professional, I'm accredited. Again, just for anyone, don't have to go Google it. Accredited, as the current definition is, as far as I know, single 200K a year for the last 2 years, net worth over $1 million, not including your household. If you're with, spouse or whatever, it's 300K is what it is. And so that's what accredited is for everyone listening. And so just baselining what you're saying, if you're accredited, you should be looking at Reg D. So we're talking about passive investments, or these private placements. private market that's opposite of the REIT, right? Real estate on it that's publicly traded.
Right.
And so things like you and Harvard Grace do hear about investments that are private acquisitions and private operations. Right. And so walk me through just, I've done episodes in this, but I just want to hear, like, with your twist on this too, with office, what does this look like? An investment from an accredited investor investing in, one of these Reg D placements for office.
Sure. We've got one going on right now. It's a medical office building. And I actually have a 2-pager that people can download on the anatomy of a syndication, but with some hypothetical numbers in it. But let's talk about this theoretical deal that I'm doing right now. So, building's about 20 years old. It's 2 major tenants, and there are some smaller tenants, but the deal works on the 2 major tenants. Just renewed their leases for 10 and 7 years. One of them is a publicly traded healthcare company. The other one's an exceptionally busy children's urgent care clinic, in this suburb of town. Just really good, high quality tenants, and then there's some upside. So we're going to buy the building for $4 million. We're going to raise about $1.2 million, which will include the down payment, loan costs, and the reserves, because we build in reserves to every deal.
Absolutely.
Just because you don't know what you don't know.
Yeah.
That's the only benefit of age that I've been able to figure out, that you don't know what you don't know. And so we always build in reserves, and we're buying it for a 8.75 cap. And we don't have any real CapEx to do to clean it up. We might clean up the landscaping and stuff like that, because that's been let go a little bit. But anyway, so now you got private investors that will provide $1.2 million. We'll be in that as well, in that class as well. We're both sponsor and a Class A passive, technically. And then from day one, on a quarterly basis, we'll start paying out what probably is going to be about a 7% cash on cash return from day one. And so every calendar quarter, all the investors will get a cash payment from us. And in this year, in 2024, you'll also get a good slug of bonus depreciation, which you may or may not be able to use on your personal tax return based upon your own personal situation. Yeah. You can absolutely use it 100% if you're deemed a real estate professional. If you're not, you can use it to offset other passive income.
Yeah.
So, and that's that. You can start to stagger these things year over year, because if you've got passive income generators, PIGs, as we used to call those, you can take bonus depreciation from later deals and offset that income. And so there's just all kinds of tax benefits that flow through to you. And beyond that, that we just operate it. It's boring. Now, there's a whole floor in that building that we're going to reposition. We're not even counting the cash flow in that one. Some of it's occupied by the seller, so he's not even on the rent roll. So we'll clean him out. We'll do some, and we'll rent that floor, and that could take a year. Probably a year to rent that floor. And suddenly you've got 25% of the building generating income, which was not the case when you bought it. So there's always built-in escalators in these leases, usually about 3% a year. So income will go up every year. That 7%, cash on cash will be like 8.75 in year 2. And it just goes on, while it's being sheltered by depreciation. And then once we do what we can lease-wise, you get the NOI up. Then what we do is we will refinance that property at the best market conditions. Hopefully, it's 3 to 4 years down the road if rates haven't gone crazy. But we'll refinance it, pull cash out, give that back to the Class A investors. We're not buying them out. We're just distributing. and so that's a tax-free distribution.
Nice.
And then obviously you've got a bigger mortgage payment at this point because you borrowed more money, but the cash flow continues, and then you can do that several more times over the life of that property. And so we're just big on maximizing the tax benefits. So, and it's all about the cash. So
Awesome. In this theoretical deal here, because we're not pitching anything, that was so really appreciate that, just outlining that in general, because that's sort of you start to finish soup to nuts on, what that deal looks like. And I want to pull out a couple nuggets for the listener here is that, you were talking about things like the sponsors, the people putting together the deal, should be looking out for. You talked about quarterly returns, and cash flow from day one. Perfect, dividends, right? Just like the stock example. You talked about the business plan. So when we hear business plan, that's what you talked about. I mean, the two tenants that you had that already meet the numbers for returns, but then repositioning a different floor is just going to maximize even more cash. And then refinancing, and then tax-free distributions. So super cool. So, for the accredited investors, go and look at some of these Reg D placements, right? 506C, 506B. I've done an episode on that previously, so have a look. I'm also invested in a medical office building since 2021. It's been doing great for me. So,
the doctor's not going anywhere.
Exactly. Outstanding. Thank you for going through that.
Sure.
And so, talk to me. I love the pigs, the passive income generators. I wrote that down. That's a good
That's
one.
an old tax person thing back when. That's how we referred to it when we had to learn the new rules about how to treat these passive activities. So
Gotcha.
the PALs, the passive activity losses, can offset the pigs. So
I love it.
yeah.
Pals and pigs. And that was what again? Passive
Passive activity losses.
Got it.
Yeah, that goes back to the 1986 Tax Act, but the terminology still holds in the really cool nerdy tax circles that I once traveled in. So,
Well, I'm digging it. So I don't know what that says about us, but I'll take it, Stewart. So let's kind of pivot here and talk about these two other topics, which is just sort of going over, since you gave that case study on business model, really, and return structure, these next topics are just going to go a layer deeper, but we can kind of go through this quick too. Is, what are some of the things that, investors should be asking their sponsors? What's things that they expect to go and ask you, and you should have answers for?
yeah. Well, funny you should ask. I have another asset on my website people can have for free. It's the 100 questions you should be asking your passive activity sponsor. But the ones that I ask them when I do them are, what is your experience in this asset class?
Mm-hmm.
How many deals have you taken full cycle? Which is a tough one when I get asked that, because we tend to want to hold our deals.
Right.
And I consider, my definition of full cycle is when I have returned all the capital back to the investor, but they're still my partners because the entity still goes on. I don't consider full cycle a sale, but it's a reasonable question. And if they are not the property manager, you want to really delve into who is the property manager and what is the sponsor's relationship to that property manager, because the property manager is the one that is charged with executing the business plan.
That's right.
Again, back to why we always do ours, because you can't expect somebody who's really getting $20,000 a year and managing 30 different properties to execute your highly developed business plan.
Absolutely.
So do we make money on that? I mean, we take whatever the customary fee is, but Lord, I'm probably making $1 an hour.
Right.
But because we're also Class A investors, I mean, it's the only way I can guarantee the business plan gets executed. So it's those type of things. And if your sponsor's been in the business, say, longer than 5 years, he's going to have one that's gone sideways. And you should ask him, well, how did you deal with it and what was the result?
Right.
He might be in the middle. That doesn't make him a bad person at all. It probably makes them a better sponsor, after
Absolutely.
they've survived it and on the other side. But you want to, but they need to be honest about it and then tell you what happened. And because real estate is like any other asset class, it goes through cycles.
Yeah.
We're in one right now, especially for office space. Everything else is going okay, but the problem with the office right now is that these people can't afford to refinance.
Got it. I love what you said about if things have gone bad, it doesn't mean to discount someone. It means they probably have more experience in that area. I was for all my tech folks listening, I was a TPM for a bit, and I've had 6 different roles at Amazon so far. One of them was a technical program manager, and when I interview people, it's tell me about a program or project that went bad. And so getting that experience is getting, your feet through the fire. It's like, having a peacetime general versus wartime generals.
Absolutely.
So
I've been both. Myself. And everybody should know, you learn 5 times more from the mistakes than you do your successes.
Yeah.
Mostly the only thing that ever comes from success is arrogance. Well, I can do that again, and you probably can.
Right.
But we analyze our mistakes a whole lot more than we do our successes.
Reflections for sure. So you keep mentioning sponsor. This is the GP, the general partnership team, which I've mentioned a couple times in the episodes. This is the team that's putting together the deal. They're the ones that are educated, know how to put things together, including the business plan. Like that model you talked about the 2 tenants meeting the cash flow numbers already, and then having a whole floor which may not come online until a year later. 3% escalators. Those are things like business plan. Anything to increase the income, lower the expenses. Think about what the tax things are as well, which you're a CPA, so that's perfect with pals and pigs. I remember that one. But talk to me then, just pivoting here, is kind of an education for me too. The model will be similar, but how do you go and underwrite an office deal? What are some of the things that you're looking for?
An office deal, really more so than a multifamily or a storage deal, is really all about the leases.
Okay.
And you're basically going to look at those leases like a banker, because you've extended extreme amounts of credit to them. Sometimes the landlord does the build out for them, and so now you're really so my rule is, you're in whatever business your tenant is in, you're in that business too.
Yeah.
So that's why I tend to stay with the simple stuff. I have done some things that had restaurants in them, but that's probably the riskiest business in the world. My dad, who was also a CPA, said, it was the quickest way to get rich and the quickest way to go broke. And that comes back to the business cycle. Their cycle is basically a day or a week or something like that. Because every time the cycle turns in business, that's when you've booked your profits. So that's why you can go broke so fast.
Yeah.
Because you book your losses that way. So I pulled these statistics the other day as part of a negotiation on another property, and I sent it to the seller and says, 80% of independently owned restaurants go broke in 5 years. So I'm not opposed to restaurants. I mean, I will, because there's different kinds. There's Mexican restaurants that are basically AAA bonds to me.
Right.
Because when was the last time you saw a Mexican restaurant go broke? Never. But then on the other end of the scale is the guy who thought, I'm going to do a microbrewery. It's like, right. All right, how many have you done? So it's that kind of thing. Doing those kind of properties, it is really all about the tenants.
Yeah.
Similarly, in multifamily, because I've had a bunch of residential units before. similarly to make your money on the buy, you make your rent on tenant selection. That's the secret to that game. And it's true in all these properties, but it's equally important on the multifamily side. It's easy to fill up a property.
Yeah.
It's a lot harder to fill up a property with great tenants.
Yeah. Yeah. There's some really cool things you mentioned there. I love the analogies too, by the way. You know, Mexican restaurant AAA bonds. It's so good. You know, thinking like a banker, it's like, sure, I think about future streams of income, but you know, sort of like life insurance as an example. It's you know, it's just math. It's actuaries. It's what are the future promised incomes, especially on a 3 or 5 or longer year lease, and that's exactly what it is, right?
Right.
So I'll give some pause and reflection on that later, but I'm certainly taking notes. Appreciate you.
Sure.
I want to be sensitive of your time here. You know, just sort of one question before we get into a rapid fire here. I mean, you made great cases already. You know, talked about hyper focusing in an area, how things like office and, you know, self-storage and gas stations are, you know, sort of following where the people are, right? And so, you know, talking about why office buildings would be such a great investment, this makes a lot of sense. Yeah, I guess I don't have a question to follow up there, but let's outro on this though. You know, you've held some, you know, you got the executive positions as well, plus COO, CFO, just to reiterate, CPA, a bunch of C acronym soups here, and which, you know, some great positions, experience, and the investor side. So, you know, tell me, like, you know, for those that are just getting into this game, right? You're investing for a long time. What are some things you wish you knew when you started?
One of them is what I just said, because when I first started doing my own rental properties, the first property I ever bought was I think a $50,000 duplex, you know, in a lesser part of town, you know, where I lived, and it had one tenant, and it's okay, I can lease the other side, and yeah, I had no framework whatsoever on how to evaluate a tenant. Somebody showed up, they said they wanted it, they had money in their hand to pay the deposit, and cool, we're done. You know, 90 days later, you're trying to figure out the eviction process because that deposit and first month's rent was all you ever saw. And I probably made that mistake 5 or 6 times before it finally, okay, maybe I need to engage some help in those kind of decisions. And there are services out there that'll check references and check histories and stuff like that for you. But that's another reason that I've sort of stayed away from residential. I just didn't really like it. I mean, people are not rational when it comes to the place that they live. And so there's that kind of stuff, and that's the reason why a lot of sponsors don't want to do property management. You know, because that's where the rubber meets the road. Yeah, is getting the right tenants, and it's just hard work. So. Other lessons that I've learned, and I've referenced this earlier, you really don't know what you don't know.
Yeah. Okay.
You do not know what's going to happen. And I did not do so well in the Great Recession, you know, in 2008, 2009, all that kind of stuff, because I was heavily over leveraged. And I had been buying properties and you know, it was a painful time, and which is why I now build in 12 months reserves to every deal that we do. And by the way, that pushes down our returns because you got dead capital sitting there not earning any money. But, you know, if you got a big tenant that moves out or goes out of business or whatever, which we just had in one of our properties, you know, you're covered. You got time. You're not panicking. And in that particular tenant, we smoked that one out while we were buying it, and we made the seller guarantee the the lease for a year. So we're okay on that one. So, you learn things and then you try to apply it to the next deal and to all your deals. So that to me just, it sounds corny, it sounds old fashioned, if you prepare for the downside, the upside take care. They become corny sayings because they're true.
Absolutely.
Because they're true. And it was harder for me to accept when I was younger. No, I've got this figured out. Hey God, it's okay, I got this. No, you don't.
Yeah. Yes, I'm reflecting about all those times. It's like, oh yeah, but I'll do it better.
Right. Yeah, it's like everybody who tries some new government program. Oh, we'll do it better this time. Okay.
Right. So I mean, plan for the downturns.
Yeah.
Keep some stuff. I mean, and in the same breath, you could say, know who you're getting in business with, and not just do you like them and trust them, which cool, but those questions you talked about earlier of what is their experience, how well do they know that asset class, because that move, just like you said about, you sniffed that out earlier for that one tenant, so you made sure that they were in there for a year. Massive, like that is a that itself, me hearing that is like, okay, well, you knew the asset class and you knew that tenant was going to be risky, so you locked them in there, so you gave yourself time.
Yeah, we saw hiccups in the due diligence work of their payment history, and it's like, and it was a medical practice. I mean, this thing was, and it's like, I mean, frankly, it was one of the reasons we wanted the building, because it was sort of a mix, medical and retail in a very high-end part of town, and it's like, yeah, something's not right here, and boy, were we right. So
got it. I know you got to run here in a second. Last question I just want to ask is, how has your vision changed for investing over time? Was it always sort of cash flow? I mean, you're talking about cash flowing now, which makes a lot of sense, but it wasn't. It was
no. Cash. The vision for cash flow has come from getting religion and having issues. I was all about get rich fast, man. So I just need one deal to get rich fast, and then I can go slow. Typical thought processes you have in your 30s and whatnot. And, there were medical device deals that had already been approved by the FDA. It's a home run. And then, oh, by the way, it doesn't work. Approval by the FDA, we learned, doesn't mean that it works. It means that it doesn't hurt anybody.
Got it.
It's not going to harm anybody. It doesn't mean that it actually works. So, and so just life, and again, the epiphany really came when I just realized I had half a dozen different clients that were in real estate, from fix and flips to buying small apartment buildings and doing this kind of stuff, and all of them, you'd never really think that they were living large or anything like that, but I started doing personal financial statements for them for banks while I was a CPA. And it's like, oh my God,
right?
They're worth $5 million.
Yeah, you wouldn't know.
And that's when that was a lot of money. And you start to reflect on that. How did they do that?
Right.
And cash flow itself. The whole cap rate. Concept, or on the business side, the multiple, the higher quality the cash flow, the higher the multiple of it, which makes it worth even more. And so cash flow may be boring, but it's also worth a whole lot of money. So I just had to grow up a little bit and mature and understand and realize that how I made my money didn't have to necessarily be fun. Or exciting, or would get me into the newspaper and stuff like that, for stories to say that I was brilliant. I mean, it is fun to me. Real estate is fun, but because there are a lot of ways to be creative with it as well. But
gotcha.
That's really what I've learned. So
I appreciate it, and I appreciate you going over with me here too.
Yeah, no worries.
So I'm going to make sure that we get some links here in the show notes. HarvardGraceCapital.com. Put your social in there for you. Those listening, please go get those resources from Stewart. Those are going to be, the 100 questions, some of the other things you mentioned, it's going to be outstanding. Really appreciate you dropped some really, really good nuggets here, Stewart. So once again, honored to have you here. Please come back anytime. Anything else that you mentioned or that we haven't talked about that you want to mention before you go?
Now, if you do go to my website, you'll find my Calendly link there. I do invite anybody and everybody. Grab some time. I can talk about real estate forever. If you want to talk about a deal you're looking at that has nothing to do with me, that's okay. I will. I have been a CPA forever, and I still have that advisor mentality, and I'm happy to give you my thoughts. You can have my opinion for free. So
yeah, go and book a call with Stewart. Be prepared ahead of time as much as you can, but go and book that call. Honestly, this is priceless advice. So thank you, Stewart. Have a great one. I look forward to seeing you soon, wherever that may be.
Thank you, Stephen. Appreciate you having me.
Cheers, brother. Thanks for joining us on another episode of Path to Passive. We love connecting with our listeners and those on the path to architecting their wealth and improving their lives. Feel free to let us know what topics you'd like to see in future episodes. Get in touch with us through email or Instagram. See you next week for a new episode.